Good evening, everyone. Welcome to IQI Canada Evening Talk. My name is Yousaf Iqbal, country head of Juwai, IQI Canada, and with me is our regular chief economist who gives an update on the economy, which is on a monthly update which we get with none other than Shan Saeed, our chief economist. Hey, Shan, how are you doing?
Thank you, Yusuf. Good morning from Kuala Lumpur. Thanks for having me again.
No, it's always a pleasure having you, Sean. And I always tell this in each and every of my show, and I want to keep saying that if you really want to know what's happening in the economies, you got to follow Shan Saeed. You got to follow him on LinkedIn. You got to follow him on Facebook. He is on Astro Avani every week. All over the media. I mean, I don't know, Sean. How do you keep up with all this? All this, I mean, you're always there.
I don't do anything. I have people around me who would manage everything.
Amazing,
Nowadays,
amazing.
I'm not adding people on LinkedIn. I'm deleting people on LinkedIn because I've already touched the threshold of 30,000 people. So I want to add more people from top business school. So nowadays, I'm deleting people from my LinkedIn.
Okay. Well, you know what? I must say that you do. I always follow you on Instagram and on Facebook and LinkedIn, and I keep seeing that, every day, you're putting something new, what's happening in the market, what's going in the world economy, especially, around this time of the year. I mean, the way things have been shaping up, I think this is very, very important for our investors and everybody as well. And you know what? Right away, we got Kashif Ansari joined us from Malaysia. Assalamu alaikum, Kashif. Thank you so much. Hello, Shan. Shan. Thank you so much for joining. So let's get started, Sean, and let's start our question right away. So the way the things are shaping up, it looks that the global macroeconomic outlook continues to stay fragile, and the markets are getting nervous now. What are the major risks to the global economy in the next 12 to 15 months?
Fortunately, Yusuf, we have again hit the market with a right call. This is July 2021, our newsletter, in which the design is done by Raza Dante. He has done a
Yeah.
very good job, so I'm very impressed by him. So we shared four risks that are going to hit the global economy in the next 12 to 17 months. And it happened much before that. So we talked about systematic risk. What is systematic risk? You have high inflation and high interest rates coming into the economy, and already we have seen a UK, a US, Bank of Canada, all these central banks have raised the interest rate. Second, we talked about that there will be a sovereign debt risk. Already, we have seen on 12th April, Sri Lankan government defaulted on its external debt, tantamount to $51 billion, and Russia, technically speaking, has also made a default. The third risk that we talked about was a liquidity risk. Once the Fed starts QET, quantitative tightening, there will be a risk in the market in terms of liquidity. Already 30th June 2021, Fed injected around $1.3 trillion in the reverse repo market, especially those banks who are lending and who are borrowing to have $1.3 trillion in the reverse repo market is quite huge. And if you recall from September 2019 till January 2020, Fed injected $7 trillion in the repo market because there was liquidity concern at that time. So I think this is the only variable that is coming in the market. The rest of the two, we have already, the last that we shared in the market was uh, equity valuation risk in the equity market. What happened on 20th April? Netflix lost 54 billion. I repeat, $54 billion just in one day. The market cap went down from 149 to $95 billion. And in November last year, Netflix market cap was higher than ExxonMobil. And as of last week, ExxonMobil's market cap is $282 billion higher than Netflix. So just imagine, it's happening at a very fast pace. So out of four, we have hit three. That makes 75% right on the dot. And the fourth one that we are talking about, that there will be equity market risk, liquidity market risk coming into the economy. That is very much on the card. It might happen in the next 3 to 4 months. And that will create shivers in the equity and the bond market, and a lot of investors, they will suffer. At the moment, the markets are not settling down very soon. There will be a lot of shenanigans, and they will be from bloodbath. I have come up with a new word. It's called financial bazooka. So bloodbath is
Okay.
a very small word. The new word is financial bazooka. So you have to remember this word for the next 2 years. And if somebody asks you who told you this word, so remember the name Shan Saeed. So this is coming in the market, and again, investors are going back to tangible assets. I think we have been talking about this for the last 2 3 years, and
Yeah.
again, we are into stagflationary environment where inflation is up, growth is low, and this will remain elevated. So, in tough times, most sophisticated and smart investors who understand history and economics, they have always taken position in real estate. So we are in for tough time. Yesterday I was in Astro Avani. They asked me the same question more or less, and I said the global economy is heading for inflationary recession. What does inflationary recession means? It means higher prices will continue for the next 2 to 3 years, and consumer sentiments will remain down in advanced economies, so consumption will go down. So it proves that recession is not a business cycle, it's a consumer cycle. When consumers don't spend, the businesses don't invest, the economy actually shrinks. So
Yeah.
inflationary recession, not only this year but also for next year, very much on the cards. So there will be a lot of shortages coming into the global economy. So it's not an easy time. Times are very tough, and in tough times, home is the safest place.
That's true. That's true. That's true. You always have this thing talking about the assets and holding up the position to assets. And I always want to keep insisting. When I met Shan Saeed in 2015, the first question I asked him, Shan, what should we do? Where should we invest? What should go on it? And first question that Yusuf, hold on to your assets, something you can hold on to. Property, gold, silver, stay on that. And from 2015 up till now, every time you made that statement, we can see that validates that every time you hold a position into the asset, that's where you are secured, and that's what helps the people to protect them as well. So Sean, magic of internet, of course, that IQI calls are documented in press and media. And right now, these are the big calls that Sean, out of four, you have just already hit about 75% on the dot. I'm going to start using some of your word, right? Simply groovy, as you call it. I'm using your vocabulary, stealing your word. If I were to relate to the economic history, like aren't we going back to 1937 era of stronger dollar and hike in rates? Is it like perfect or wrong analogy? What do you think? What do you say?
Yes, Yusuf, it's a perfect analogy. What happened in 1937? Dollar was getting stronger, and Fed was hiking interest rate at that time. And again, it created new bankruptcies, it created inflation at that time. We are heading back to the same era where we will have bankruptcies, we will have, a lot of countries making default on their external debt, which happened in case of Sri Lanka. So, these are not normal times. And when stronger dollar happens, what is the strategy? Stronger dollar is not good for the global economy. Global economy needs a weaker dollar so that it can spur growth not only for us but also for other economies. And when stronger dollar comes into the market, it creates a lot of impact on emerging markets. Emerging markets, they sometimes they don't really hedge themselves against the stronger dollar. And not only emerging economies but also for many investors in equity and bond market, they don't really hedge themselves against the currency risk. So whether movement in dollar upward or downward, it creates an impact on all asset classes. So right now, I think stronger dollar is happening because it has created a safe haven, and we are back to 1937 era. And Fed, in the last 24 months, they have uh, created $4 trillion in the market. 70% of the $100 bill is not in US, it's outside of US. So imagine if those investors who are holding those $100 bill or $100 note, they start, uh, offloading their dollar position. So again, it will create a ripple effect. So I think, in my opinion, Fed has played it's card wrongly. They should have raised the rates at 2 years back. They did not do it. They did not know how to create inflation. The easiest way to create inflation is to let your currency depreciate. Once your currency depreciates, the inflation automatically comes into the economy. But Fed was maintaining the status that okay, we will have a 2% inflation target. It could not achieve from 2010 till 2018, 2019, and finally we have seen the the turnover of dollar has gone so high that now inflation is 8.5. And Fed does not know. If you pick up any issue of any magazine or newspaper, they have been talking about that Fed has been behind the curve. And even this round, I don't think that Fed is in a position to curb inflation. Inflation will remain high. I've spoken to a few economists in US. They are saying, according to independent sources, inflation is not 8.5, is not under single digit. It's around 14 to 15% in US.
So we are live with Shan Saeed. If you have any questions, please ask us, and we will be definitely would like to answer any of your questions. So Shan, as right now you're talking about the Fed, so I'm just going to talk about that. About the latest economy magazine which came in. So what do you think is the game over for Fed? Like, I mean, latest issue of Economist magazine says that says so. So what's your view on that? And I also want to share a little slide about it. The Fed
Oh
that
yes, the picture. They say, Yusuf, they say the picture speaks it all. You
yeah.
see, the gentleman is holding his forehead. It shows that the game is over for Fed. If you see, this is some people were saying the Fed can control inflation. 1979 is back. In 1979, the debt was only $0.8 trillion dollars. Today, the debt is $30.4 trillion dollars. Fed has increased its balance sheet from 2008 from $800 billion dollars to $9 trillion dollars in 2022. Just imagine. So they have created so much of money, and Netflix is just one simple example. More examples will come. Every month you will see, equity markets staying volatile. Just give you statistics. Last week, I was sharing with someone, investors lost $1.2 trillion. Dollars. It's not even in
Wow.
billions. Now people are
Wow.
talking about billions. $1.2 trillion investors lost in the US equity market. First quarter this year, investors have lost $7.9 trillion in the equity markets alone. So imagine 7.9, 1.2 trillion is $9.1 trillion, which is more than the GDP size of Canada, Spain, Indonesia, and Russia. $9.1 trillion investors have lost year to date. Year to date means starting from 1st January as of today, that is 25th April. Investors have lost nine. So Fed has played its card wrongly. Fed is panicking, and investors are looking at very, very closely. When Fed is panicking, they are moving out of the equity and bond market. Just if you pick up the latest report from Bank of America, investors have withdrawn $17 billion last week from the
Wow.
equity market. $17 billion gone. And where that money is going, they're going into private investment, they're going to real estate, gold, silver, farmland, arts. Look at Bill Gates. Bill Gates has bought $786 million of farmland in 18 states in US. You
Wow.
love coffee, you love rice, you love wheat, so do I. And everybody needs agriculture products. Population is growing. The demand is still very much strong. The supply is not coming. Obviously, you will have agriculture inflation. And people who are holding on to farmland, who are holding on to the agriculture product, they will make a lot of money. So again, real estate, these land in tough times, the only fixed asset that goes up is land, and
That's
IQI
true.
is dealing with that. So I think Fed has lost the game. I don't see that inflation to remain under control for the next 2 to 3 quarters. It will remain elevated, and we will have similar situation uh, for the next 2 to 3 years, and global economy will only recover in 2025. So what we have been talking about, that inflationary recession is now the new buzzword, and it will hit many advanced economies. And those economies that have got deep fiscal space, they will suffer a lot, just like Sri Lanka, Turkey, Argentina, uh, Pakistan, Tunisia, Nigeria. These countries are quite vulnerable to external shocks because of higher oil prices, higher commodity prices, and there's a lot of volatility in the market.
So we're talking about the economy to be recovered by 2025, which is next 3 years.
Yes, sir.
Uh, Also, like again, what is also related is the U.S. dollar. So what's going on? Why is U.S. Dollar appreciating? What's the outlook?
Everybody's asking me since yesterday, Shan, why the US dollar is appreciating. Yusuf, it's very simple. The inflation is high. So, how do you curb inflation? You have two monetary tools. One is appreciating currency, and the other is you hike the interest rate. So, what the central banks all over the world, they have got similar strategies, similar monetary tools, similar mandate. So, they allow the currency to appreciate. So once your currency appreciates, the import that you bring into the country becomes cheaper.
That's
So
right.
once imports become cheaper, things get cheaper. So your consumers, they pay less, they don't pay more. Right now, US consumers are paying more because of higher inflation, and you have your currency in a depreciating mode. But now, US dollar, it has appreciated 3% in the last 2 weeks.
Hmm.
It gives relief to US consumers, to have cheaper things to buy, especially on the
Yeah.
imported items. So this is part of the tactical maneuvering. All the central banks globally, they do tactical maneuvering, strategic maneuvering according to the market situation. And the only way forward for Fed is to let the US dollar appreciate for the next 2 months. I see US dollar appreciating, and then in H2 is going to slide further because stronger dollar is not sustainable. It can't remain at the dollar index of 102, 103. It will go down under 100, and it might stay between 95 and 98 going forward. And by year end, I see a US dollar between 93 and 95. So I think US dollar appreciating is part of the tactical maneuvering because Fed understands if they hike interest rate, it will create a lot of trouble in the equity market, and the markets have started pricing in. Look at equity market last week. S&P was down, Nasdaq was down by 3.8%. Dow was down by 1.8%. S&P 500 was down by 2.8%, and investors lost $672 billion just in one day. $672 billion just in one day on Friday, last Friday. And
Wow.
the whole week, investors lost $1.2 trillion just in equity markets alone. And when I'm talking about US equity markets, everybody, the whole world, invest in equity markets, and not just the US consumers
That's right.
or the US investors. Everybody globally invests in US equity market because US equity market has got the highest market cap globally speaking. So I think Fed will continue to use tactical maneuvering because they know they have lost the game and they don't know how to control inflation. Bank of Canada has also raised interest rate
That's right.
because they are seeing a lot of movement in price. So in order to curb inflation, most of the central bank this year, 45 to 50 central banks this year will raise interest rates globally.
That's very true because that's what we have seen in terms of the interest rates, in terms of controlling the inflation, and Bank of Canada has come up with that. And in fact, that was my next question to you, as well, especially on the inflation side of it. So look, let's come to the Canadian real estate market. Rising interest rate regime and inflation outlook. Like, do you think like this is going to dampen or put the brakes on the real estate market in Canada, which is already quite buoyant? Because what I have, just a little analysis, and then you get your analysis that whenever the interest rates goes up, it does slow down the market a little bit. But in what we have seen realistically is going up on that. So what's your outlook on that? Especially we're talking about another hike coming up probably in June.
Yes, Yusuf, whenever there is hike in interest rate, short-term movement, yes, investors would see because they have to lock in their loan portfolio with the bank. So they will have a wait or see approach. But I can share with you, I have got data right in front of me. This is Economist magazine, March issue, where it talks about the Canadian. This is 26th March,
Wow.
31st March issue of Economist magazine, page 68, and I read: half of adults aged between 25 and 35 in Canada have bought properties.
Wow.
And it talks
Nice.
about millennials are buying property boom at last. You know, millennials are not buying, and this is the article from Economist magazine. And you can share it. I can send you the PDF. You
Please.
can share it with your sophisticated and smart investors in Canada. Yusuf, the way I see things, I have already shared with you. We are back in 1970 era.
Yeah.
Stagflation is going to hit advanced economies. And during stagflation, people who understand history and economics, they have always taken position in tangible assets. And when I talk about tangible assets, it means real estate,
Yeah.
gold, silver, farmland, arts, vineyards.
That's right.
So
That's
the
right.
way I foresee things, and you have already shared the number of immigrants who are arriving in Canada.
That's
So
right.
where they are going to stay? Will they stay on the roads? No,
No.
obviously everybody needs a room. You know, everybody needs shelter
Yeah.
to make their living. So I think real estate prices will move up, and not only in Canada but also in US in a very structured manner. Look at US year on year growth in New York 20%. Year on
Yes.
year growth in New York, Lower Manhattan area, Brooklyn, Queens, Browns, all area 20% year on year growth. So I think the way things are shaping up, Canadian real estate market in short run, there might be a wait and see approach from investors, but long run, we are quite at IQI, quite buoyant. The way Canadian economy is attracting investors globally because of the perception of Canada. It's a very
Hmm.
macroeconomic stability, healthcare system, world-class education, a work-life balance is there, and the job opportunities are building up. And the biggest advantage that Canada has right now, which I say to everyone, all those countries that are producing oil and gas,
Yeah. Yeah.
they will remain rich. You have already seen in Calgary, you have seen in
That's right.
Alberta,
That's
all
right.
these oil sands in Calgary and Alberta will witness a lot of investors because right now there is shortages of workers in the energy market. So when the shortages of workers, there will be a time where companies will start hiring. You talk about Schlumberger, Shell, Exxon Mobil, all of these companies are still on the lookout. Although capex is down, but they still like to hire people who have skill set to match. So I think once they start hiring, so areas like Alberta and Calgary, they will remain very, very hot. Not only that, but Toronto, which is the main hub, which is the like the financial capital of Canada, it will remain very hot. And your favorite place is Mississauga, where all the Adil Hayat Ansari is living. So I think all these places will remain very hot, and investors would like to take position in places where places are booming. And real estate, it moves with the economy. If economy is booming, real estate will boom as well. So it's always the macroeconomic variables, the fundamentals that drive all the industry, whether it's real estate, whether it's manufacturing, whether it's oil and gas. So overall, at Juwai IQI, we are quite buoyant on the real estate market despite interest rates going up in Canada in June, as you rightly pointed out. Wall Street Journal and Financial
Yeah.
Times and Economist magazine, all they have indicated that interest rates would rise in Canada. Despite all that, we still believe that those sophisticated investors, they will take position in real estate because tough times ahead. And as I always say, in tough times, home is the safest place.
That's true. That's true. That's true. And you know what? Again, okay. Question for you. I think Shan, Malaysian ringgit, Asian currency. Your outlook on that. That's the question from Kashif. Let's talk about this question, and I'll just wind up what you just now said on it. Please go ahead.
Kashif again, Kashif again. Yes, a lot of people have asked me this question, Shan. Are you worried about ringgit? My answer is simply no, because we understand macroeconomics better than many people. In 2015, on 29 September 2015, ringgit was trading at 445. 16th January 2016, ringgit was trading at 4.48. Right now, the strength in US dollar will create ripple effects on all emerging market currencies. Ringgit will stay. Today, ringgit is down. Yesterday, ringgit was 4.37. Right now, when I'm on the screen, ringgit is trading at 4.35. US dollar index, it touched 101.71 right now. Dollar index right now in front of me is 101.57. So dollar index is down. Short term, US dollar will stay stronger. I'm saying bring it trading between 4.30 to 4.50 in the short run. But year end, I still stick to my original forecast that I made. It's all documented in our newsletter. 3.75 to 4.15. Bank Nigara would never allow ringgit to appreciate because they want to keep the exports competitive. Malaysia is competing with Vietnam, Indonesia, Philippines, Thailand, and if all these currencies they depreciate, obviously central Bank Nigara will keep ringgit in the depreciating mode. So I think depreciating ringgit, nothing to worry because it's going to boost. All the central banks have got three mandate: price stability, growth stability, and financial market stability. So Bank Nigara will continue to follow its mandate. Short run, yes, ringgit will depreciate. Long run, ringgit, the confidence in ringgit will come back.
Great, 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 great. Thank you so much for that. And just coming back to the economy, of talking about the interest rate outlook for the Canada. The few points which you really mentioned was that the Canada has marketed itself very well at the time of pandemic in terms of the safety, security, and immigrants coming in. So definitely, when we talk about the Canadian real estate market, a lot of questions have been asked. The reason I want to get your view on is that because I've been getting a lot of questions from my team and from my investors. What's going to happen exactly? Is the property price is going to go down? It always slows down. It's going to go. The interest rate will go up. And exactly what you said, I told them. I said, if you are a buyer or investor looking to get into it right now, or a first time home buyer, this is the right time to do it, because in a month, couple of months time, we will see again the way the price will go up, because as you rightly said, there's a shortage of supply. The supply is not there. A lot of immigrants coming in, a lot of international students coming in. All these students are graduating. They're looking for, once they get their jobs, they're looking to buy properties. There's so many things are happening on that. So we always tell people, like, people are always asking, like, well, what if I'm gonna, it's gonna go more down, and I want to buy at a lower price, and then I want to sell at a higher price. I always tell them, look at the analysis. If tomorrow you wanted to sell your property for 1.5 million, even if you're selling it for 1.3 or 1.4 for with the market, with the market is going on, we're also getting a better deal in terms of buying as well. So you rightly mentioned that this is always a cyclic adjustment which happens on that. But I strongly believe that the same thing, that we will see that the real estate market will continue to grow. So Shan, anything else you want to add up to our audience before we say bye to them?
Yes, Yusuf, what you just mentioned, what the inference that I can make at Juwai and IQI, why investors have been attracted to us. There's only one reason: because of our service. And number two, we talk about data. We don't talk about Cinderella stories. We don't talk about tabloid stories. There are many people who are doing that. We are not into that game. We are into facts and figures. We are interested in our credibility, our integrity, and our morality. So, why you have done from 25 million to 200 million? Because you have given good service. And giving good service to clients, that is the hallmark of our of IQIs, the brand equity. So, data, giving good service, giving good analysis. So I think that is the hallmark, and that is the a cornerstone of our philosophy, that how to serve clients for the long term, because we are long term players. We are not short term. We sell property, then we say goodbye to clients. No,
That's right.
we want our clients, our existing clients, to come back. We believe in repeat sale, because we believe that when we have a relationship with any investor, with any client, we should maintain that in the long run. So I think at IQI, we believe in data analysis, how to make interpretation of that data, and giving strategic guidance so that investors can, profit from our insights, and they can benefit in the long run. Kashif just asked me,
Yes, I was
uh,
going to say that there's a question here. We
bond
can't
and
let you
equity
go, so we
market.
have a question for you. Bond and equity
I,
market, where you say?
the way I see things, bond is the worst asset class to be in. Your inflation is 8.5, and your 10-year yield note is giving you just 3%. If you just do simple maths, 3 subtracted by 8.5, you get negative minus 5.5. You're not making money. So bond is the worst asset class to be in because you're not. And if you recall, Yusuf, we have been doing this program, and in February 2021, Warren
Hmm.
Buffett said, I am offloading my bond position and I'm going long on cash,
That's
and I
right.
will
I
not
remember
take
that.
position in the bond market. This
Yeah.
is February 2021. And now today we are in April 2022. Bond market is facing a lot of problems because investors are offloading their position. As far as equity is concerned, once the interest rates keep rising, there will be a lot of shenanigans. There will be a lot of bazooka. Already investors have lost $9.1 trillion year to date in the US equity markets alone. So I think if you are smart, if you are clever, you would take position in those asset classes that give you peace of mind. So the peace of mind is oil and gas, gold, silver, arts, farmland, real estate. You want to touch your assets. Real estate can keep on appreciating. Stocks can go down to zero. Bond prices can go down to zero. We have seen Sri Lanka zero.
Yeah.
We have seen 12th April, Sri Lanka raised her hand and said, we are on default. We don't have enough money to pay on to our external debtors. So I think real estate will continue to be on the global investors radar. Equity and bond markets, they will have a lot of challenges because of rising interest rate. Your market cap will go down, your earnings will go down, your cash flows will get squeezed, and your debt servicing goes high. So when your debt servicing goes high, obviously it makes a huge impact across all the specters of the company. So I'm not very optimistic about the bond market. I will never advise anyone to take position bond market, worst asset class to be in. Take position in real estate, gold, silver, arts, oil and gas, uh, vineyards, farmland, equity markets. Take position in those stocks where it gives you dividend yield. Otherwise, I think, as I say, financial bazooka is the new word. You have to remember the name Shan Saeed.
Absolutely. You know what, Chan just gave me an idea. Maybe I'm going to invite next time Kashif to be a part of our discussion as well. So it's going to be really, really a fun, program which we can have with you and Kashif together on that. So I'm going to request Kashif to see if we can bring him in our next Chance economic update program along with you. That'll be good, right?
Certainly, certainly.
Great, great. Thank you so much, Sean. Really, really appreciate it. Always excited. See, I know Kashif is always excited. Kashif, you are the one who always keep us excited as well. So thank you very much for that. Every time I feel like it's getting a bit lower, all I have to just call up Kashif and get all the excitement from him.
The
So thank you
energy
so much
comes
for
back.
that, Kashif.
The
The
energy
energy
comes
comes
back.
back right away on that for me. Especially, I mean, when I was like, I need to get that energy, call up Kashif and I get boosted up. I'm sure everybody does that as well. Thank you so much, Kashif. We will do that for sure. Sean, thank you so much for your time. Really appreciate it. Have a wonderful week. Have a wonderful month. Eid Mubarak to you in advance. For
Khair
next time
Mubarak.
we are there, inshallah, Eid will be coming out next week. Take care of yourself.
Inshallah.
Thank you so much, Sean.
Thank you, Yusuf. Eid Mubarak to you and to your family.
Thank you. Bye
Assalamu alaikum.
bye.
Bye bye.